In the last several weeks, volatility has been extreme, and it's during times like this that it becomes really hard to be a successful investor. Whether you're new to this or you've been investing for several decades, today we're going to share the secret to real-life success, especially when things get rough. That's coming up right after this. Welcome back to Wealth Wednesday. This is a show to help you make better decisions about money in your life. If you'd like to learn more about us, you can find us on our YouTube channel. That's at Commonwealth Financial. You can also find us on the web. That's at cfswb.com. If you like this video, hit that thumbs up button and be sure to subscribe so you don't miss our next episode. Welcome back, and joining me today is someone who's helped clients navigate through some rough times over the past 30 years, Michael Cease. Mike, thanks for joining me today.
Thanks, Neal. Always glad to be here. I love this topic because after nearly 3 decades in the business, I've seen it over and over. It just keeps repeating itself. The biggest challenge that investors face, it's not about interest rates or charts. It's more about emotions than anything else during these times.
So let's talk about that. We both know markets go through cycles. It's part of the deal, but it's what people do during those cycles that often makes or breaks their long-term results.
That's absolutely true. I mean, when the markets get rocky, people feel like they need to react. They have that urge that they have to do something. And sometimes that urge can be extremely strong, especially during these steep sell-offs or drops that we have. The more volatility, the more they want to do something. And so the biggest thing is, I mean, nobody likes seeing their investments or their hard-earned savings take a hit. But the reality is downturns are just part of the journey of investing. It happens all the time. Our brains are really wired to protect us. It's just a survival instinct that we have. But in investing, letting your emotions take the wheel can cause more harm than good most of the time.
Yeah, it reminds me of that commercial, one with the guy, the chainsaw that's chasing the teens, and they choose to hide in the shed full of sharp tools instead of getting into the running car. That's what emotional decision looks like. So every advisor has their horror stories, especially during the big bear markets like the dot-com bust from 2000 to 2003. And of course, the Great Recession in 2008. I knew a guy who cashed out his entire 401k, paid the penalties and taxes just because he couldn't take the drawdown during the Great Recession. I had another one sell within a week of the 2003 bottom and went to government bonds and CDs. Not sure he ever recovered. So as advisors, we've all seen those moments. Let's add in another layer, and that's how the media influences investor behavior. It's not exactly calming.
No, the media doesn't help at all, Neal. I mean, I say that thousands of planes land and take off every day, but what makes the news is the one that doesn't. The media thrives on drama. And they'll send topics like markets plunge, investors panic, global crisis. Whether it's politics, trade tensions, or interest rates, it all gets amplified through the media. And one of the things that's kind of really interesting now, 30 years ago, we weren't bombarded with news every single second of the day. And investing wasn't that 24/7 spectator sport that we have now. And one of the biggest things, they didn't have access to their accounts like they do by just touching their phone now. So in some ways, it was actually easier to invest when you and I both started. And it was easier for investors to kind of succeed because they didn't have all this outside noise that kind of causes all these emotions. So it takes discipline more than ever to really succeed here.
Mike, let's shift gears a little bit here. True or false? Investing success has very little to do with intelligence.
Absolutely true, Neal. I've worked with some incredibly smart people. We have doctors, surgeons, engineers, CEOs of companies, but that really doesn't make them immune to the fear and emotions when it comes to investing. So what matters isn't really how smart you are. It's really how disciplined you are when it comes to investing. So your behavior and not your brilliance or intelligence is really what helps keep you on track and keeps you from making those big mistakes. So the best investors I've worked with, they're the ones that have a plan. They're the ones that stick to the plan, and they understand that we're going to have ups and downs. And so there's times when you do make adjustments, but when the market is taking a huge hit, that's usually not when you make those big adjustments.
Yeah. So do you have a real life story that kind of drives this point home?
Well, I mean, you and I both have lots of stories, but I remember, COVID was really the last major downturn that I remember really well. Like everything was not going well. And I'm sure we both had clients that would call in and ask us what to do or get out of the market. But I had a client that really called in during really almost the bottom of in early March of 2000 that said they wanted to get out of the market. And I asked, why now? And this is someone that's been a long-term investor, and they've been through multiple downturns. And they said, this time is different. And so usually when someone says that to me, I said, what makes this different? So everyone has a reason why this time's different. But in reality, market downturns are just a normal course of being an investor. So usually when someone panics like that or gets emotional, I'll ask them, do you think the market will be higher 2 years from now? Most of the clients always say yes. So usually the best thing I do with clients is once I let them talk, share their emotions, and get that off their chest and kind of say why they're concerned. Then once they get their emotions a little bit more under control, they understand that, hey, it's not the best time to get out. But during the COVID time, I did have one client that got out in mid-March, and they never did get back in. So they never did recover. The clients that did stay in, they've recovered and had additional growth. So my advice is, I don't have a problem being a therapist for the market at that particular time, but stay in and follow your plan.
Yeah. And I think one of my best examples is I have a client who was a barber for over 50 years. And he's been a very successful investor over time. And his methodology doesn't always make sense to me, but he's done very well. And here just the last couple of weeks, he called me up and he said, yeah, buy another 1,000 shares of this. And it's really a testament to the idea that it's someone who gets it. He wasn't a college educated guy. He just understands that you buy low and eventually sell high, or just buy low and hold it forever, which is kind of what he's been able to execute. One of the very few people that I've worked with who has pretty much perfectly executed that buy low or that buy and hold mentality. Mike, let's leave our viewers with something actionable when Mr. Market starts getting irrational, unpredictable, and downright bipolar like we've seen lately. What should investors actually do?
Originally, Neal, I had 3 things, but I think there's 4 things that's really important here. Number 1 is pause. Take a moment. Don't act in fear. Take a step back. Let the emotions get a little bit under control. Number 2, if that doesn't calm your nerves completely, talk to someone. Call us, call a friend, and just get some perspective. Talk to someone that's been through it along multiple times. Number 3, stick to the plan. When we sit down and do financial planning with clients, we have we do that yearly with clients. We look at where they are, where they want to be, go back and review that plan and see if it's still on track. And I think the 4th thing is turn the news off. We talked about it earlier in the conversation. The news is just a speaker amplifier that just causes more stress. So if your investment strategy only works when everything is good, it's really not a strategy, and you do need to reevaluate it. But I would say just don't panic.
Great advice, and it's a perfect reminder. And I'll leave you with this. Here's a great quote from the Oracle of Omaha, Mr. Warren Buffett. You can't predict what stocks will do in the short term, but you can predict that businesses will do well over time. Just take the 20th century. The Dow Jones Industrial Average went from 66 points to 11,497 points. You had 2 world wars, a Great Depression, a flu epidemic, and so forth. American businesses will do fine over time. The only person that can cause you to get a bad result in stocks is yourself. So if you're watching this and feeling uncertain, please remember you are the most important piece of your financial plan. Not the headaches, not the markets, you. Until next time, stay grounded, stay patient, and stay invested. And if you need someone to talk to for that extra dose of perspective, reach out to us. Visit us anytime at cfswb.com. Have a great week, and we'll see you next time on Wealth Wednesday.